Good afternoon, everyone. Welcome to today's webinar, Candlestick Charting, Catching the Next Big Move. Today's presenter is Steve Nison, President and founder of CandleCharts.com. Welcome, Steve.
Thank you. My pleasure being here.
My name is Tom Hartle. I am CQG's Director of Product Training. I'll be your host and moderator today. Before we get started, I want to mention a few housekeeping items. If you have any questions during the webinar, please enter them into the Q&A section window at any time during the presentation. We'll have Steve answer the questions at the end of his presentation. If you're viewing the presentation in full screen, you can find Q&A in the WebEx toolbar at the top of your screen in the drop-down menu on the far right. If you're having any sound issues, please contact the host via the WebEx chat. We'll be recording today's webinar, and it will be posted within 48 hours to the events section on news.cqg.com. All registered attendees will receive an email with a link to the recording. Now, I'd like to introduce our guest presenter. Steve Nison, CMT, holds the distinction of introducing Japanese candlestick charting to the Western world. As such, the foundation of all candlestick information in America and Europe is based on Mr. Nison's work. He is regarded as the Western world's top candlestick expert, as well as an expert on Western technical analysis with over 30 years real-world experience. He's the author of 3 books on candlestick charting, which have been translated into 12 languages. Mr. Nison's work has been highlighted in the Wall Street Journal, Institutional Investor, and Barron's. He advises to top institutional firms, and he's also lectured at numerous universities and at the World Bank and the Federal Reserve. Welcome, Steve, and now I'm going to turn the webinar over to you. Thanks.
Great, thank you so much. And for some reason, can you see my screen?
Yes, we can.
Great, okay, because I can see the main window. Let me see. Teleconference assign. Oh, there we go. Great. Okay, so thank you, Tom, and it's a real pleasure doing this for CQG. They were one of the first charting services in the Western world to use candlesticks. And we're going to be looking at various markets today, but be aware that all the examples that I show are applicable in any market in any time frame. All we need is an open, high, low, and close. And what we're going to do is just quickly start with the essentials. First, I just want to bring out, as Tom mentioned, I was the first to reveal candlesticks to the Western world. So when you learn candlesticks from my shop, CandleCharts.com, you know you're learning it the right way. Unfortunately, there's a lot of well-intentioned educators out there who are teaching candlesticks, and a lot of the information is wrong. Everything I'll be talking about in this session, in this very short session today, has been corroborated by at least 2 books, Japanese books that I've had translated. I've had dozens of books translated. I've spoken to top Japanese traders. So, these are strategies refined by generations of use. So the Japanese, and also in a lot of proverbs, Japanese proverbs, and here's one of them: if you want to cross the river, you must first build a bridge. So many of you may be familiar with candlesticks already. And by the way, let me mention, I'll stay around a couple of minutes to take any Q&A, any questions. So if we could hold off until questions until the end of the session, that would be great. And so with this in mind, let me just go over the basic construction of a candlestick chart. A candlestick line is made of 2 components. There's a rectangular portion called the real body, and the real body is a relationship between the open and the close. If the close is higher than the open, as you see here, we have an empty or white real body. If the close is under the open, we have a black real body. And again, this could be for any time frame: a 1-minute chart, a 30-minute chart, a daily chart, even a weekly chart. Depending, and also the high of the session is the top of what's called the upper shadow, and the low of the session is the lower shadow, the bottom of the lower shadow. And whether it's a white or black real body, and depending on your charting service or your preferences, instead of a white real body, it might be a green real body, or instead of a black real body, it might be a red real body. But essentially, looking at the real body and the shadows give us volumes of visual information about who's in control of the market at the time the candlestick line is formed. So, for example, here are some patterns: a hammer, Japanese will say the market's hammering out a base, very long lower shadow, the market's rejecting lower levels to close at or near the highs, a shooting star is a top reversal signal. At some point during the session, the market had rallied. By the end of the session, it closes off. And here we have Doji. Okay, Doji are sessions where there's no real body or very small real body. And with the Doji, the Japanese would say the market is in balance between the bulls and the bears. And very often, Doji are good indications that the upside momentum is running out of steam. So, for example, here, we mentioned about the importance of the psychology. Let's think about this. What are each of these candlestick signals telling us about the psychology of the market, right? Think about it. Obviously, with a hammer, the market is rejecting lower levels. Look, if the market was weak, in this case it opened over here, it should have closed on the lows. Instead, it sold off and rallied to close. It opened here, sold off, and managed to have a bounce to close over here. Likewise, with the shooting star, we could see it's a bearish indication. And the Doji represents, as I mentioned, a balance of forces between the bulls and the bears. So let's see some real-world examples of how this works. So here, the bulls are gaining control, long green candle, and then all of a sudden you have a Doji. The Japanese would say, with a Doji, the market is losing its breath. So on this one session, and this is what the candles do, give you potential reversal signals. In 1, 2, or 3 sessions, we're getting a sense that the upside momentum is running out of steam. Okay, so there the bulls are in charge, and here we have a Doji. Now, obviously, I can't give you my 30 years experience in this short webcast. There are lots of things you could do with Doji. For example, between the high of the Doji and the high of the prior candle, if you do sell short on the Doji, you should have a protective stop, whichever one of these has a higher high. So you'd have a protective stop up over here. And by the way, candlesticks are especially good for futures and commodities. When I was doing my research into the candles back in the 1980s, I actually worked at Merrill Lynch, and for you old-timers out there, you may remember E.F. Hutton. I was giving trading strategies to the futures brokers. I worked in the financial futures department at Hutton, and I worked in futures at Merrill Lynch. And when I was doing my research in the candles, originally it was all in the futures market, because back then, in the 80s, really the only short-term traders were futures. And obviously in the 90s, with the advent of online internet trading, the equity markets picked up how powerful the candlesticks are. But they work really well in futures. Okay, so here we have a shooting star. And this particular signal I like. You notice that blue horizontal line? Now, there's a strategy I call falling off the roof, because there's a Japanese proverb that says, let him climb the roof and then take away the ladder. It's really a false breakout. So notice how the market broke above resistance and failed to close above that resistance level. And so this is what falling off the roof looks like. You have a multi-tested resistance zone. The market punches through resistance, then gets back under the resistance level. You could actually set a protective stop at the highs that the market made, and the target is the most recent low. So, for example, once the market got under this resistance area, you would set a protective stop here, and the target would be the most recent low, which would be down here. So that would be a nice little profit on this particular short-term trade. Now, the opposite, and you can see we're not only talking about candles, but we're also talking about some of my favorite Western indicators. Although I'm best known for candlesticks, since I've been using them in the West and revealed them, in the 1980s, I've been using Western technicals since 1974. And in my more in-depth strategies, and I'll tell you a little bit more how to get access to them a little bit later on, I combine Western technical indicators with candlesticks, because it's kind of like your 1-2 punch for successful trading. I'll show you some examples of how I combine Western indicators with candles in a couple of minutes. But another indicator I like using, this is not a candlestick indicator, but it's one I use a lot, is a crack and snap. You have a support area, the market cracks under the support and snaps back above it. Your target is the most recent high, and your stop out level is the low here. So here, for example, we had a support zone. The market broke under it intra-session. It got back above it. So one could think about buying it, keep a protective stop. Whenever I place a trade, I always put a protective stop on. Protective stop under here, and the upside target are the recent highs over here. So we could see how we could use candlesticks as well as any Western indicators, because think about it, with a candlestick line, you use open, high, low, and close. What do you use to make a bar chart? That's right, open, high, low, and close. So any of your favorite Western indicators, so for example, these are some I use on my CQG. I use Fibonacci retracements, trend channels, Bollinger Bands, stochastics, and RSI. Whatever your favorite Western indicators are, just add them to your candlesticks. Here, for example, we have what the Japanese call a rising window. We in the West call it a gap. This rising window is a support area. And within the support area, we got a bullish hammer. And we can see what happened there. And my targets usually are based on recent highs and lows. So on this hammer, my target just would have been the recent high, a little above the $61 area. But we can see this hammer. Look at that long lower shadow, how the market's rejecting lower prices. So even with the essentials that we're talking about, candlesticks here, you can see how much nuance, how many nuances you can pick up about the feel of the market, the emotionalism, who's winning the battle between the bulls and the bears. Here you have a hammer. Another hammer over there. And notice the title of the slide, Importance of Stops. If the market closes under the low of the hammer, so here's the low of the hammer. Notice how it closed under there. If you're long on the hammer, you should be out of long positions. Okay, the most important aspect, in my opinion, of trading is risk control. So here, if we have a hammer. If you did a trade on the long side from the hammer, your protective stop would be here. So can you imagine if you bought the hammer and you did not let yourself get stopped out here? Look at all the pain, financial pain you would have been under. And I place a stop as soon as I do the trade, because that is when I'm emotionally not involved in the trade. You know, once you're involved in the trade, you start second-guessing yourself. You start moving your stops. So my strong recommendation is put the trade in as soon as you put the stop in as soon as you do the trade. Now here we have a hammer, and here's a trade I did. All right. So normally the low of the hammer is a support area. So I actually bought this on the bounce, because I'll look at intraday charts. This is a daily chart, but I'll look at an intraday chart to place a trade. So I actually got in over here. Now, normally the low of the hammer would be my stop out area. But, or actually I got in the trade over here, sorry, over here. And normally the low of the trade would be my stop out area. But, and that's my target, by the way, that was my target. Okay. But look at this low over here. Wouldn't it be upsetting to get stopped out over here, right? To get stopped out over here, only to have the market hold the support area over here. So that is why I set a protective stop over here. And that's why the title of the slide is Hammer as Support. But there's subjectivity involved because I nudged it a little bit based on the recent lows. Now, as I mentioned before, here's one of my trading principles. And I'll tell you how you can get all my trading principles in a couple of minutes. But here we have a trading principle. And I alluded to this before. Because the candlestick signal uses the same data as a bar chart, open, high, low, and close, all your Western charting techniques can be used as on a candlestick chart. And here, for example, is one of the books I had translated. And I wrote this in here. This is the title of the book because I don't speak Japanese. So my translator gave me the title of the book. And this was, I numbered them actually. So this is actually number 8. But anyway, interestingly, on the cover of the book, notice how we had candlesticks and a couple of moving averages. And there was a cover story about me a few years ago in magazine, and I like the title they came up with. And this was their idea for a title based on the interview, Helping East Meets West. And I'm a strong believer in combining the best of the East, that is candlesticks, with Western indicators. Okay, let me show you an example of this. Oops, let me go back here. So here we have a shooting star, and this takes on extra significance because look at the prior high. It's confirming a resistance area. The more signals you have joining up the same area, the more likely reversal. Okay, here we have two Doji. And by the way, the plural of Doji or Dojis. All right, so now let's add a Western indicator, RSI. And one of the ways you could use RSI is overbought, oversold. And look at the difference we see now with this perspective. On the first Doji over here, the market is not overbought. So the market is not vulnerable. Not surprising, because we had a bullish, what's called a bullish engulfing pattern, the green wrapping around the red. So the market just starting to rally. Now over here with this Doji, and by the way, this is considered a Doji because the real body is so small, I would equate it to being the same as a Doji. At this point, the market is much more vulnerable because, as shown in the second circled area, the market is really overextended to the upside. So we could see how viewing even a basic candlestick signal like a Doji in context, that is with the Western indicator, should increase your success with using candlesticks. One of my indicators that I have on many of my charts are Bollinger Bands. I like using them as overbought, oversold indicators. So here we have a series of Doji representing the top ends of the Bollinger Band, at the top end of the Bollinger Band. So you're getting confirmation that the bullish momentum is vulnerable because the market is overbought. And we can see what happened after. Here's a quote from a book I had translated. Combinations of bullish and bearish candle lines indicate the direction of the market and investors' psychological conflicts at important turning points. So here we have engulfing patterns. We have a bullish engulfing pattern, the white wrapping around a black real body, or it could be a green wrapping around a red real body, and a bearish engulfing pattern, the black candle wrapping around a white real body. So here we visually see the bulls are taking over from the bears, and here the bears are taking over from the bulls. All right, now here's a good example of how not to use candlesticks. Somebody purchased one of our resources, and they only got, they only had the basic information. It's kind of like what we're doing here. And they saw the shooting star, and he shorted based on the shooting star, and he sent us an email telling us that he got out the next day at a loss. And so he was saying, well, the candlesticks don't work, blah, blah, blah. And, obviously candlesticks are not 100%. That's why I always suggest using a protective stop. But the issue, I told him, was he did not he didn't have the complete education. He was looking at candlesticks in isolation. And the Japanese would say, something like that is like looking through the sky from the bottom of a well. So I told him, actually, I thought this was a great shorting opportunity. Now, what do you think? There was a shooting star. What was it confirming? Think about it. Go back here. Right, it was confirming a resistance area, right? So you had a candlestick signal confirming a Western indicator. And if you sell short on a shooting stop, remember what I said about stops. You should always place a protective stop. And one of the things you could use candlesticks for is using that candlestick signal as your stop out level. So the low of the hammer, as we saw before, remember when we were talking about protective stops, should be a stop out level. The high of the shooting star should be a stop out level. So yes, the market rallied after the shooting star, but should that trader should he have still been in that short position? Of course, because it did not get above that stop level. If you sell on a shooting star like this, you must be willing to risk to a move above the high of the shooting star. Just as if you buy in the hammer, you must be willing to risk to move under the hammer. And then the market did this. And that's when he invested in more of our educational resources, because he realized that he missed a great trading opportunity because he only had limited information about the candlesticks. Okay, little quiz here. And you think about this for a couple of minutes. You don't have to type it in, but there are 4 signals here that hint of a reversal. Think about it. Okay, some are candlestick signals, but there are other signals. So play a little Jeopardy music. Dum, 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 dum. Interesting story about the Jeopardy music. Merv Griffin was the producer of Jeopardy, and he wrote the theme music. It's actually, I think, called the Thinking Song. And he said it took him maybe 10 minutes to do. He just had a piano and did it one night. And he's since deceased, but his family, his estate still gets, I think, between $5 and $10 million a year on royalties from that song. So that's why I'm not allowed to play it officially. I could hum it, I guess. Okay, so let's give you another minute or two. Yeah, in a lot of my educational resources, we have a lot of these chart challenges. Traders love these because it's really a great way to refine your knowledge and also, you know, kind of solidify what you learned. Okay, so let's go through these. Obviously, you picked up, hopefully, the Doji. Okay, you see this red wrapping around the green, right? Bearish engulfing pattern. Okay, so those are the candlestick signals. Now, where do you think I put the Bollinger Bands on? The market got to the top end of the Bollinger Bands. And not so obvious, but something I look for is, notice how the market was going from higher highs and higher lows and higher closes. And during this confluence of indicators, the Doji, the bearish engulfing pattern on the top of the Bollinger Band, the market was going from higher highs to the same highs, so essentially just running out of steam, expanding on the base. And something like this, you know, I would jump all over from the short side, assuming it's a good risk-reward, with a protective stop above the high over here. Okay, which do you think is a better trading signal? Once again, you could just do this mentally. Is bearish engulfing pattern or the shooting star? Think about it. All right? And I would assume most of you are saying, actually, why don't we type it in? I want to make sure I can see you. I don't know if I can see questions or not, unless Tom is going to be sending it to me after the, after I do my talk. Yeah, okay, I don't know if I can see questions or not, or what, but anyway, okay, great, Kelly. The shooting star. The shooting star. Okay, Tom and Kelly, why the shooting star? And Alex, why did you say the shooting star? I hear crickets in the background. No reason, right? And the correct answer is, okay, with that in mind, I'll see you next week at the same time to give you the answer. Okay, Tom says more significant indecision. Well, yeah, the shooting star is indecision, but if you look at this, aren't the bears and bearish engulfing pattern taking over from the bulls? Look at that huge black real body compared to the white real body. But the answer is you don't know. Why? Because this is looking, remember what we talked about, the risk of the danger, I should say, of looking at candlesticks in isolation. And with that in mind, I had this cartoon made up. I work with a cartoonist. To know where you stand is as important as candle pattern recognition. So here you see the master chiding the apprentice, who obviously hurt his thumb, saying you must learn to properly use the tools. And we're starting here to just kind of doing, starting down the road of education with the candlestick. So getting back to the prior slide with the bearish engulfing pattern versus shooting star, the reason you don't know the answer is because of my trading principle number 4. I have 15 trading principles, and actually we're going to be raffling off later on. One lucky winner will be getting all 15 of my trading principles. So we'll be doing a raffle in a couple of minutes. And these trading principles are my key concepts based on my 30 years of giving trading strategies and trading based on candlesticks and Western technicals and risk management and so forth. So one of these trading principles is you always have to take into account risk-reward. So let's get back to that, the shooting star and the bearish engulfing pattern. Here's that bearish engulfing pattern. So let's think about this from the risk-reward perspective. It's not a bearish engulfing pattern until the market closes. And yeah, Kelly's saying, thank you, context is key. That's exactly right. Context is key. It's a good way of putting it, Kelly. Anyway, by the time you get the signal, at least my target would be down here. Look at the risk on this trade. Bad trade. Here we have a shooting star. It's okay to have a little bit of a lower shadow. And think of this from a risk-reward perspective. The risk is only up to here, and my target, my target wouldn't be here. I'd just have a recent low over here. My target would be here. So on this shooting star, a much better risk-reward trade than this bearish engulfing pattern. Critical concept of risk-reward. Okay, one of the bonuses that people get who invest in our full-day sessions, we have them available either as DVD or streaming videos, is they could email me questions. And so here's a question, and that's why we call it insider access, because we have a private special email address that only those who have our resources get, because we get so many questions from the general public, and most of the questions are answered actually in the resources, but if there's something that is not, is beyond the scope of the resources, my educational resources, or something a student is not sure about, they do get a special email address, and we answer them personally. So, for example, here Gary says he went long on this bullish engulfing pattern. Why he went long? There's a bullish engulfing pattern. See the green wrapping around the red, that's support. It broke a falling, it's a little hard to see here, but there's a falling resistance line, so it did break that resistance line. And Gary wanted to know, was this a good trade that didn't work out, which happens, or did he make a mistake in judgment that he couldn't see? And so we let him know that he made a mistake in judgment. And the mistake in judgment was risk-reward. And what it was because, why? Because he bought in the bullish engulfing pattern, so the risk is here, and the potential profit was up there. So the risk-reward was 1-to-1 at best. And normally when I do a trade or recommend a trade, we like a risk-reward of 1-to-2 or even 1-to-3. There's a Bloomberg an article in Bloomberg magazine, Fortunes Are Made by Those Who Can Call the Next Turn. And what we started to touch on in this session is showing you those early reversal signals with candles that let you get into a new trade, a new trend, before your competition can spot it. So here, for example, on Netflix, okay, on the weekly chart, okay, we had two bullish engulfing patterns. And look what it was confirming, a major support area. So key level at $55. Okay, so that's on a weekly chart. And here on a Eurodollar chart, and just for those who trade Forex, same concept. We are looking at a weekly chart, a hammer here, a bullish engulfing pattern here. And what I'm going to do now is zoom in on this area where the rectangle is, because it's a weekly chart, and I'm going to show you what happened on the daily chart. And this is going back to August and September. So here is the daily chart on the euro. Once again, even if you don't trade currencies, everything I'm talking about now can be applicable, can be used in any market. So we had a bullish engulfing pattern, another bullish engulfing pattern, and another bullish engulfing pattern. And let me show you something interesting about the significance of early reversals. Here's that same market again with these three bullish engulfing patterns. And I like looking at moving averages. And here we had a crossover. And the problem is, by the time you got a crossover on the moving averages, the market was up here. You got your reversal signals on the bullish engulfing patterns either over here, or over here. And this is exactly what I mean by a jump on your competition. Okay, so for those who trade Forex, you could have made an extra $1,700 on the standard lot. But even if you waited till over here. Okay, so the highs in Apple. Remember, fortunes are made by those who call the next turn. We had, obviously, a series of Doji. And one of my favorite Western candlestick indicators is a gap down, a falling window. So we had a falling window here at $700 in Apple. Now, we had what's called a dead cross. That is a Japanese term when a short-term moving average crosses under a long-term moving average. And I like looking at a 20-day compared to a 50-day moving average to get intermediate-term trend. So if you waited for that to become bearish on Apple, you would have gotten the signal $50 later than you would have up here on that falling window. So that's an extra $5,000 on 100 shares. You know, many of us are not going to be trading Apple or Google outright because it's so expensive. But, you know, let's say you did an option trade. All right? Same concept. Falling window. We have a theoretical $700 put, an at-the-money put, theoretically priced at $25. We do the same thing. We wait for a bearish. If we wait for a bearish dead cross, with the market at 650, and at-the-money put at that time theoretically would be worth $58. So even with options, by using the candlesticks, you had an extra $3,300 on one option contract. And this is just one example of the timing power of using candlesticks to enter or exit the market. Let's say you were long. Wouldn't you like to exit positions up here on the long side rather than down here? So I'll stay around a couple of minutes for some questions, and Tom will have some concluding comments. But let me just give you this. Just for attending the session, you know, as a thank you for attending the session, or if you're viewing it on a video, go to this link down here, and I'll just post it in a second, and you'll be getting a free ebook, the 4 common and costly mistakes almost every trader makes and how to correct them instantly. Also, I'm going to invite you to a webcast where you could ask me a trade suggestion or what I think about any U.S. market or Forex market of your choice. That is at no cost to you, that we normally charge $149 for. And we also have special pricing on our full day seminar at this link. So I'm just going to post a link here and just go there. And this is going to be ending very soon, so I suggest you go to that as soon as you can. And let me do, as promised, a raffle. And let me see if I can see all the participants. Okay. Okay, so Tom, I think you said you were going to do it because I don't know if I could see the participants. And the winner will be getting the Nison trading principles. So I'm trying to get a list of participants, but I can't do that. So, Tom, do you want to do the raffle?
Yes, we've completed that, and the winner is Tim Pott.
Tim Pott. Congratulations, Tim. And just email Paul. I'm typing it now in the chat window, paul@candlecharts.com. And he will send you all 15 of my Nison trading principles. So congratulations on that. And if you have any questions at all, or if you want a custom designed educational package, we have 1-day sessions, 2-day sessions. We have candles for Forex. We have candles for options and so forth. Contact Paul at candlecharts.com. So with that, I'll I'll turn it over to Tom for a couple of minutes. I'll spend a few minutes because I have to actually leave very soon because I have to set up my trade for tomorrow. I'll stay around a couple of minutes for questions. So Tom, back to you, and then I'll stay around a couple of minutes.
Well, thank you very much for that, Steve. I do have one question regarding the FX markets. They trade 24 hours. Does that have any? Do you have any thoughts about the best way to approach that fact?
Yeah, candlesticks in Forex are different than candlesticks intraday. Sorry, candlesticks in Forex and intraday are different than candlesticks in daily charts because even intraday, the opening and closing are very close to the same, and Forex, because it's a 24-hour market, the opening is almost exactly or very close to being the same. So I can't get into detail here, but essentially, like the bearish engulfing pattern, the black candle wraps around the white candle. In a Forex, it's okay if the opening of the second candle, the black candle, is the same as the close of the prior candle. And we actually have, and that's why we have resources on Forex. We have special candlestick resources on that. So you could ask Paul about that. But it's a great question. There are subtle differences between the candlestick signals in Forex and non-Forex. But essentially, as far as how to use them as support and resistance and reversals, they're the same whether it's Forex or non-Forex.
Okay, thank you. We have a question from Tim. When you enter a trade after a signal pattern, do you enter right after the signal occurred, or do you wait for the next candle to confirm the pattern?
Yes. Talking like a true politician. There's no right answer on that. The way I look at it depends on risk-reward. If you want extra confirmation, let's say we have a hammer. You could wait for confirmation the next session. That will increase the odds of the trade working out. What it'll do is increase the. You'll have a bigger stop though. So in other words, let's say we have a hammer that's completed at $10, and you get confirmation at $10.50. I still talk in fractions, my old Wall Street habit. And you get confirmation at $10.50, and let's say the low of the hammer is $9.75. If you bought on the hammer, you'd only have a 25-cent stop-out level. If you bought on confirmation, it would be 50 cents because you're buying at a higher level. So there's no correct answer. It depends on your risk adversity. I personally like waiting for a little confirmation. However, confirmation is less needed if a hammer or a candlestick signal is confirming support or resistance. Usually I suggest if you have a candlestick signal by itself not confirming Western indicator, I'd wait for a little extra confirmation. And actually, I could see the questions here. Kelly's asking, have you used candles in market profile? No. But doesn't mean you shouldn't. I haven't used. I used to use market profile. I remember when market profile came out in the 1980s. Back, as I mentioned back then, my focus was futures. But I really haven't used it since then. So I think it would be a great way to, combine them. Okay, what's your favorite? Steve. Okay. And what's your favorite other technical tool of a candle patterns? I just like horizontal support and resistance. Let's keep it simple, stupid. That's what I like. And I have other indicators also, but that to me is one of my favorites. And I'll take this last question. Oh, and let me put this up here because people, just in case somebody wants to go to that link again, write this down because once the session is done, this won't be here. Would you say that patterns work better after the end of trends rather than range-bound conditions? I really like range-bound. Think about this. If you have what the Japanese call a box range or range-bound market, if you get a bearish signal at the top of the range, what's your target? The bottom of the range, right? If you have a hammer, say, at the bottom of a trading range, and the target is the top end. So I really like box ranges because you then have potential targets. So, that's my subjective view of it. I really like box ranges. And at the end of a trend, as far as end of trends, candles are great for signaling trends as they're ending or as they're beginning. Okay, so thanks so much. Tom, any comments or?
No, that's it. I'd like to say thank you very much for your time, Steve. This concludes our webinar, and as I mentioned at the start, this webinar is recorded, and we'll send a link to everyone via email within the next 48 hours. Thank you again, Steve, and thank you, everyone.
Great. Thank you, everybody, for joining us.